We've got an additional conversation coming up here discussing risk, but then also emerging markets. There's a lot of liquidity here within the United States or a lot of developed countries. But I'm excited to introduce to you guys John O'Connor, the CEO of RealFi, for our next conversation. So without any further ado, put your hands together as he comes up stage. Knock him out.
Thank you very much, everybody. I'm John O'Connor, and at RealFi, we believe that great businesses should be able to raise capital no matter wherever, no matter which country they're in. And we achieve this through the power of data. So mom and pop businesses are the lifeblood of emerging market economies. They create 70% of all jobs and account for almost half of all GDP. Yet they are ignored by a broken banking system that is incentivized to ignore them. So what do we mean by this? Well, in the United States, you're probably used to the fact that banks are the people that you go to when you've got a small business that you're trying to raise capital for. In countries like Kenya, this isn't the case. Banks instead lend to government. Where I live in Kenya, the government currently offers an 18% infrastructure bond. This sucks all of the oxygen out of the room. All private capital, all financial institutions would rather lend to government than they would doing all of the work to understand small business risk. And this is a ginormous problem. But there is a solution. What we've seen happen across the last 10 years is the emergence of a new kind of financial actor. And this is what we call fintechs or fintech lenders. They've emerged to fill the gap left by banks, but they are not banks. They have no retail deposits. What they are is very good at understanding particular kinds of business risk. So one fintech might be an expert at underwriting market traders in Nairobi. Another one might be really good at creating portfolios of solar home systems and lending to that segment. Across the last 10 years, we have 2 times more fintechs than we used to, and they also receive 10 times more venture capital funding than they did before. But these fintechs, unfortunately, have much the same challenge in raising capital as the small businesses which they look to support. They really have only 2 options. The first is debt financing. So they'll go to a large credit fund or a large financial institution, and they'll say, look at the quality of all of the businesses that I've been lending to. Why don't you provide me capital in order to be able to lend to more of these businesses? And what the financial institution will say is, where's the collateral? Why would I lend to a portfolio of businesses in Kenya unless you can provide me with collateral? But as we discussed, these institutions, these fintechs, they don't take retail deposits. So how can they grow the amount they're lending? How can they support more of the small businesses that we really care about? The second option they have is to come maybe to Vegas or to Silicon Valley and say to a venture capital firm, look how big the total addressable market is here. Look how important this work is. And the VC might say, well, yeah, that's very interesting. But taking equity capital to be able to lend to businesses is a really expensive way of raising money. Every founder will be looking at this journey and saying, by the time I've grown this fintech to the scale that I'll be happy with, I'll have diluted myself away to the stage where actually maybe I shouldn't even be doing this at all. So even though they're doing incredibly important work, it's very challenging for them to be able to raise capital. So these challenges are compounded by, unfortunately, really massive fraud. I think when people think about emerging markets, they may also think about certain examples of scams or things like that, which they've heard about. So what we've got here is 2 different companies or 2 different fintechs. The fintech on the left is the bad apple that spoiled the bunch. The fintech on the right is a really exceptional company. Both of these firms came to us at RealFi and asked for a 7-figure investment. I'm happy to say the company on the right, we provided capital to. The one on the left, we didn't. So company A, the bad apple, they claim to have 9 million customers in Nigeria. These are smallholder farmers who they provided a smartphone to. Included in that smartphone was an app that let the farmers buy agricultural inputs, buy seed, buy fertilizer, buy pesticides, and then sell their produce on the back end. And this is a lease-to-own model. So the smartphones they do repayments with across time. On the basis of this story, they actually reverse merged onto the NASDAQ in the United States to be able to raise more capital and achieved over a $500 million valuation before a US short-selling firm, Hindenburg Research, started to diligence the company. Of the 9 million customers they claimed, they could not find a single customer. Of the $568 million this company claimed to have in their Nigerian bank accounts, they could find only $46. So stories like this create a massive perception challenge. All of the great fintechs like the one on the right, 10 million customers doing over $1 billion of lending, has done a 568x return for their seed investors. They pay the price of having fraudsters like Company A in the market. They really poison the well. So the market opportunity for lending to fintechs in emerging markets is ginormous. It's $260 billion. The question then is, how do we find the right fintechs to lend to and provide them with financing opportunities that they actually want? And the answer is data. The average fintech has 30 million rows of lending data updated daily. The best of them use this information to grow their businesses and optimize their decisioning. Excel models are not sufficient to be able to capture the financing opportunity that this data holds. The data sets are simply too large to load. Excel cannot open 30 million lines of microtransactional data. What we need is real-time connection to the raw data, machine learning, and open banking systems. And this is what we do at RealFi. RealFi is risk management meets data. So if you look on the left of the diagram, you can see the data from the MSMEs. These are real businesses that we want to support. Their data gets ingested by the fintech lenders and is presented across 4 different areas. Management accounts, you guys are probably familiar with. These are your 3-statement models. The loan tape data is this microtransactional data, these 30 million lines updated daily that I'm talking about. The third item is cash movements. Well, every time a fintech lends to a business, there should be an audit trail in the bank accounts. I should be able to see a transaction going out and then a transaction with the money being repaid coming back in. And the final piece of data here is impact data. Who are we lending to? Are we lending to women entrepreneurs? Are we lending to rural areas? Are we lending to businesses that are offsetting climate change? All of this rich information is important for us to understand the social good that we're generating with our capital. So at RealFi, we take all of this information, we ingest it, we clean it, we structure it, we standardize it, and more importantly, we interpret it. Jack Ma said that data is the new gold. Well, I think there's a lot of data, and what's more important than data is interpreting it and turning it into executable outcomes.
Enjoying the event? Fire up that wallet and delegate your ADA to Rare Stake Pool. For over 3 years, Rare has been committed to providing high-quality staking services. And we're now Chang Hard Fork ready. Thank you for your support.
So at RealFi, what we do to protect investors who are interested in participating in this space is, first of all, we catch fraud. Whilst it's very easy to manufacture your management accounts, it's very difficult to make those management accounts match the microtransactional data you have in your loan tape and also match the transactions which are coming from your bank account, these deposits and these receipts. So we build this 3-legged stool which lets us invest into this emerging market segment with confidence. The second thing we do is model the future. So we use these loan tapes as leading indicators over what's about to happen in the future. The third thing we do is scenario tests. We can check about the ratios of debt to equity or asset coverage or all of the other things investors might care about. And finally, we can track impact. We can understand what every single dollar generates in terms of social good. And this is what RealFi does. So you can see on the left is our deal discovery and monitoring platform. This is where, as an investor, you can learn about various deals, you can expand through our data-driven underwriting process, and after you've deployed capital, you can also monitor the status of your investment. This is really important. Rather than just diligencing when you deploy capital, what about understanding the current health of that investment in the real world as time passes? The second thing we have here is our data-driven decisioning. So this lets us look through a portfolio and see segmental analysis. Is it better to lend to men or to women? Do the default rates vary across these two segments? Well, actually in emerging markets, they do. It's much better to lend to women. And as an investor, you might be interested in only supporting a particular segment where you're comfortable with that risk. And finally, impact analysis. So this is where you can see what social good you're generating on every dollar that you deploy. All right, so who are we? Well, I'm John O'Connor. I was the first hire of Cardano Foundation. I've been working in IOG for many years. We have Danelle, also my partner in crime, who was CPO of Input Output before I poached him towards RealFi. We also have a proven tech leadership. We've got some great talent here from some of the largest banks in South Africa. Liam was a senior data scientist at Facebook and at Meta. And in terms of our finance leadership, we've got deep expertise across private equity, credit funds, traditional finance, and private wealth management. Okay, so we've talked a lot about emerging markets, but why is this relevant for Cardano? Why is this relevant for Web3? From our perspective, real-world assets need real-world data. One of the biggest challenges we've seen with protocols like Maple is that they let investors be exposed to companies like Alameda Research without actually understanding the operations of these businesses. So everyone was looking at the yield, seeing great returns from Alameda, but were they looking at the risk? And this is what's wrong currently with the way in which we're doing RWA. If we were to think about Tether, ubiquitous across the crypto world, the original proposal was that every dollar which was issued as a crypto token would be matched by a dollar in a bank account somewhere. Tether is now the largest fintech in the world, and only 2% of its balance sheet is actually held in dollars. 50% is held in commercial paper. This is lending to large corporates, or large corporates is what we'd hope. If they were lending to Apple and Microsoft, you probably feel quite fine with that. If they were lending to Chinese cement manufacturers, you probably wouldn't feel so okay. So transparency about what people are buying is crucial. And that's the space which we're playing in RealFi. Whilst we're starting with SMEs in Africa, we think this data-driven model is crucial for RWA to become a serious segment within Web3. Currently, we've deployed around $5 million towards SMEs in emerging markets at an average return of 15%. We've got around $50 million worth of validated debt instruments currently, and we're working with investment firms and funds across the world to be able to expand the scale of our operations. In phase 2, we'd like to take execution from offline, where it currently is, onto the platform, enabling investors to have an end-to-end process from discovering an opportunity to deploying. We'd also like to build out the linkages which will let the debt assets that we're curating get moved onto the Web3 world and enable participation through the RWA space. And finally, in phase 3, we're lending to more fintechs than anyone else. We have integrated all across the global south, and we have more information about the small business in the global south than anyone else. And with that, we can do some really exciting things with both ML and AI that we're really excited about. All right, so last slide. Well, I'll just leave you with one final thought. What happens if we succeed? So the $50 million of validated debt that we have currently, what happens if we were to fill that this year? Well, that amount of money deployed across 5 emerging markets should generate $7.5 million of interest repayments, support 500,000 small businesses, of which 65% are women-owned. And we think that's pretty cool. My name's John O'Connor. You've been learning about RealFi, where we unlock emerging markets through data. Thank you very much.
Rare Evo 2025 tickets are on sale now. Save big General admission passes are discounted to $250, and VIP passes are only $800. Join us August 7th through 9th, 2025 at Caesars Palace, Las Vegas. Hurry, only 30 days left to save. Visit rareevo.io and buy your tickets now.